a little.
Tell me when you get it straight.
Yeah, yeah, it's on.
2 o'clock here. We gotta walk
It's
out
on.
and put jackets on.
That's hilarious. I thought he walked by and I was like, does he have something on his, like, something's going on? But I didn't know you. I couldn't tell. You did a good job.
6, 7, 8.
afternoon and welcome to Chicago Future of Finance. I'm Oliver Rennick. We are back here in Chicago on Jackson LaSalle at the Cboe trading floor where there's a little bit of action today. We've got a pretty interesting market. We got a bunch of data coming up, a lot of tension in the market, but stocks have just been continuing to grind after a little bit of a pullback. We got Noel Smith who's going to join us to talk trading, Scott Bauer who's going to talk trading. We're going to hit a lot of ETFs with Tim Urbanovic joining us from Innovator with a couple new twists on the buffer funds that have been so popular. Cynthia Murphy, who knows the ETF world inside out, is going to be joining us as well. And we're going to have a real deep conversation that I see coming over the next month around the world of ETFs, which have just become absolutely massive. Judging by viewership around those topics too, it still is a really big subject. So we're going to continue to kind of probe every corner of the ETF world. John Najarian's joining me for The Gamble as we continue to talk about the future of trading, which involves event contracts as well and the binary market of Kalshi Poly market. If we take that ISO again, I'm going to do a quick little recap here of what I learned over the last 2 weeks. It was a very informative couple of weeks as we did the show live from the Robinhood Summit in Las Vegas, which was a fantastic event. Kudos to Vlad and Q and team there and Obi for putting together a really great series of panels as well as a conference that reminded me of the good old days of the brokerage conferences, TD Ameritrade, when we all just started about almost a decade ago. So to see that legacy carried on at Hood Summit in Vegas was fantastic. Also, RMC in Munich was quite an experience to see the institutional trader there, the international minded and sophisticated approach. That was a really interesting conference. But what was so important about all of it is how much they shared in common. There's a reason why Cboe was the backbone, a main sponsor at Hood Summit, and then of course running RMC is because options truly are at the heart of what is the nucleus in markets right now, where the edge and the action is, which is a reminder for why we're here doing the show. And I never felt more compelled about that truth than I do after spending the last basically 10 days abroad, where the rest of the world has some pretty good things going for it, namely the clean water in Germany. You can drink that shower water. But the cleaning ladies are a little bit intense on the timing for the exit. What makes America great is that every 2 hours, we don't change time zone and language. It's a neat museum that Europe is running, but the homogeneity of a massive economy that is the US is pumping the strongest. It's also why China's number 2, which wraps me in my last week because it capped off with a great night in Paris at the Ritz, hosted by Dakota and Guy Costin and team, one of the sponsors on this show. Great connections. Those guys know how to throw a party. So it was a great couple of weeks, but we're back at home. Let's bring in Noel Smith, who's joining me from Convex Asset Management, who is also with us in Las Vegas and is one of my top volatility minds right now. Noel, tell me what you see in the market. We're going to get a little feedback from the AI that's got some thoughts on the JP Morgan collar trade. There's a lot going on. Take me from the top down, what you're looking at right now.
Well, looking at cross-asset vol across the board, it's pretty calm. I think the market isn't really sure if we're going to, shut down or not. And if that happens, if we get the data that we're looking to get. So there's a lot of questions about that. So
Kalshi says like 80%. We're going to trade that with John in the next block. Kalshi says that shutdown's coming.
Yeah, I saw the same thing. If you look at any kind of stats about previous shutdowns, it really hasn't been that big of a deal. And if it was, I guess the marketplace would be reflecting that. You'd see the implied vols bid across the board. If you look at bond vol, commodity vol, stock vol, everything is kind of flattish. So I don't see some big risk because of that.
Okay. Generally, we had a little bit of a kind of bump in the road with markets pulling back just a tad from the highs. It wasn't that big. 6 days ago, we got a few days lower. But the vol complex, did anything notable change from that?
What I found to be most notable is to not freak out. If you looked at, again, cross-asset vol, if you looked at what else is going on in the marketplace to tell you to take action on that. So, okay, the market goes down a few, understood. But what do you do with that? Do you sell it? Do you de-risk? Do you buy more? And our judgment was to fade it because we didn't see anything that was a real risk to the marketplace. It was more idiosyncratic to the equities.
Okay, so nothing macro-wise. I'm with you, too. It's hard for me to get worked up about the shutdown stuff. It seems like it's just in nature. It's like part of our system, what we do now in America. So not that it's a good thing. Maybe it's one of those other things. I don't know. I don't want to get back into Europe versus U.S. stuff. Noel, what do you kind of see also? Because you've been to those international events. You were with us in Vegas. What do you think kind of was the main message in terms of how people are using volatility as an asset class right now?
I mean, maybe it's one of the reasons that, you and I ideologically click on this, but I mean, options are driving so much of what's going on. I would like for people to understand that do trade options, the importance of how they can really affect what's going on in the marketplace. And sometimes they dominate what's going on in the marketplace. I learned that really where you are right now on the floor, which is sometimes, if a large option order comes in and then the stock that's traded to hedge that out ends up dominating the tape for the next hour or two. That kind of stuff is something I think that people should really notice. And I think people at like Robinhood were noticing. Obviously at RMC, they all know that. But there's just this understanding that the derivatives market can sometimes be the most important thing that you can learn from.
Okay. No, one of the things in derivatives that's pretty big is the JP Morgan caller that is rolling tomorrow. So this is also kind of one of those stories where the kind of everyday pro-tail trader got caught onto this and the role that this big ETF, this fund is having as it basically sells calls, buys, downside protection either through spreads. It kind of informs this baseline discussion we're going to have with a guest today who has buffer funds. So much of this market has been about trying to hedge equity risk to the downside. And so this big JP Morgan fund, do you feel that it actually makes ripples in the market?
It can. So it went up today already. There's a preliminary print. I think the upside strike was 69.55 or something for 35,000 SPX options. So that actually happens today, not tomorrow. And it doesn't really matter unless we are expiring near strike. So I don't think that right now the strike that expires today is the 65.05 strike. And if we were there, it would completely matter. But I don't think it matters right now because we're too far away. And so we're just going to roll up. And all the people that, if you think about it, if you were in that investment, all the upside between 65.05 and where we are right now, that's gains that you never made. So that's the other side of this trade. Yeah, you hedge some of your downside, but you also forego some of your upside.
Okay. Let's pull in the AI. I asked the AI to see what kind of it's catching on to about the JHEQX is the ticker, by the way. I basically just said, what does the trader, kind of everyday person need to know about, especially on the roll days? AI's response was, the flows don't just reset hedges. They create a time window where dealers are simultaneously exiting the old strikes and warehousing risk before the new collar is fully laid on. That overlap means temporary long or short gamma exposure leaks into the tape, which I guess suggests that it thinks this thing is tradable. Tell me what you think about that analysis.
Do I think somebody's taking leg risk with 40,000 SPX options? I don't. I just don't think that's happening. I think these trades are well known ahead of time. I think they're prearranged, and I don't think anybody's taking that kind of leg risk or being that reckless with that amount of money. We're talking billions of dollars. There's no way.
Yeah. Okay.
I disagree with the AI.
Okay. Now, in terms of it making ripples, though, maybe they're not like visible, tradable ones, but still something that I guess once it's over also has the potential to kind of reduce vol in some extent. Is there any of that in there? Is there any truth to that?
Sure. So again, if it was visible and tradable, then it would be front run, right? So if there was something to be done, everybody that's standing behind you would do that something. So that makes nothing but sense. Again, if we were at strike, near expiration, past day or two or three, or even today, and we were right at strike, the idea that we would move a bunch today, I'd be very reticent. I would try to fade those moves. In other words, I would expect that gamma would compress or the gamma would expand, but the volatility of the price movement would compress on an expiration if we were at strike. But we're so far from strike, I don't think it really matters today.
Okay. And honestly, I love that answer too, because even though I find it, an emblematic strategy that does represent a lot of the thematic stuff happening right now in the market in terms of, hedging downside and obviously the role of volatility too, options in big strategies, all that stuff I love, but I've never really bought into the notion either that it's like a super tradable thing for most people. So generally, when you look at kind of how to capitalize on what seems to be an environment where vol fades and stocks grind or at least hold support, Noel, what kind of trades are you doing? What makes sense to you?
So we basically have like different vol regimes. And when we don't see any big trouble on the horizon, we keep beta exposure to the marketplace. We keep our positions kind of as is. We're looking for those inflection points where something goes from a steady state to some kind of a next transition phase. And that, we classify that as like a yellow zone or a red zone. And that's just not on the radar today. But if you look at the VIX futures, VIX futures options, ZN options, all kinds of stuff that really matters to the marketplace, there's just not something saying that some roll is coming and therefore we have to freak out, or we have to trade in front of it or whatever else, you would see it. You would see it in price action. You would see it in the options.
Yeah. Overall market pretty solid. Some of the kind of higher beta stuff like the MicroStrategy was a little bit softer earlier, but NVIDIA is strong today. S&P's marginally higher. I mean, it just seems like it's going to have to take something real to kind of break the wall here that has held pretty strongly, Noel. And, I look out on the horizon this week. We're going to talk the shutdown thing as well, but looking at the data, nobody's expecting the data to bomb. ISMs are expected to come in on the services side above 50, manufacturing below 50, the same kind of regime we've been in. So if you think that we're going to hold the regime, should we be just buying calls or should we be selling downside? What's kind of the approach?
So if you look at the NDX, you'll see that the upside calls are a bit bid, and the at-the-money calls near term are not that bid. In other words, they're kind of supplied. So I think if you want to have NASDAQ exposure, I think a call spread makes a lot of sense because you're buying relatively cheap vol and you're selling relatively expensive vol. Again, I think that's a better call than just buying options or just selling those upside calls.
And you think NASDAQ has more of an opportunity in vol pricing right now than S&Ps or small caps?
I think that setup exists more in NASDAQ. In other words, there's more of a sharp inflection of upside call skew in NDX than there is in SPX. Yes.
Okay, nice. Something, I guess, tech there to be said a little bit, right? Yeah. That's kind of also the place generally where you bet on the stuff that's carrying you back comes from that, sector, comes from that category.
Yes, correct.
All right. What else we got? No, if markets just grind, then, I guess we just keep putting in highs, Fed's cutting. It doesn't seem like there's I've had green on stocks for my risk radar for a while, so I guess I hold it that way.
Same. We have a dispersion trade on. It's working. If you look at NVIDIA trading $4.5 trillion today, that's crazy. And you have other stocks that are kind of doing their own thing. So dispersion continues to work. Vol harvesting continues to work. Beta exposure continues to work. And short vol bond strategies continue to work. So we don't have much to complain about. I don't think the sky is falling.
Okay. Well said, well argued. Like the trades in there, looking at the upside call spread for the NASDAQ and looking at VIX, pretty calm, back to normal. Good stuff. Love it. Noel, nice work. CIO, Convex Asset Management, joining us from Las Vegas. P.S. My wound has healed from our bike ride, Noel. Almost. I was traveling around Europe. You know what else the Germans do well? Bandages.
Yeah.
They've actually... Yeah,
I felt bad about that. For viewers who don't know, we went for a bike ride together, and he crashed, and he had a little boo-boo on his knee, and I felt bad. It was kind of bloody.
It was pretty rough for a couple weeks there. So all right, put my overconfidence into check. Got to manage my risk a little bit better on the bike. Thanks for the lesson, Noel. Appreciate it. Good to see you. Can we pull in John? Go straight and talk to Mr. Najarian, because I think that a lot of this conversation kind of bleeds into some of the stuff that John and Pete have been looking at and we've been talking about. Let's hit the gamble. Mr. John Najarian, how you doing, sir?
I am fabulous. Thank you very much, big guy.
You down in Florida? Are the vibes as good in the tropics as they are here in the Midwest when it's 80 degrees?
Let me see. It's 90 degrees here in Puerto Rico today.
Oh, you're in PR today. That's right.
It's beautiful. Bright blue sky. And I'm pretty enthused.
What a painful place to have to get your 51% of residency, John.
It is a challenge, but I'm up to the challenge.
Yeah, I know you guys are. All right, well, good to have you back again. We're talking a little bit of some of this short-term, maybe governmental risk. My take with Noel, I kind of agreed with him, John, is we've done this thing over and over. It almost seems like it's like a staple of our political system at this point, these shutdowns. But Kalshi says it's 80% chance it's going to happen.
Yeah, well, we've done it 14 times since 81. It's likely this is going to be the 15th time. So the people that are betting on those prediction exchanges are pretty spot on, I'd say.
86% right now, they're saying shut down tomorrow.
Yeah, and, that'll be at 1 second after midnight tonight. I think we're likely to see that. And there were already scheduled about 100,000 people that were going to step away from their government jobs. because they were offered early retirement and they took it. Trump wanted them out because these were deep state folks, and the threat here is, I think, very real that there could be a lot more cuts if indeed we if we don't get to a CR, a continuing resolution, a clean one. I don't think the president and or his vice president are bluffing about that, and we're staring down the barrel right now.
It's interesting that at 3 p.m. 2 days ago, this thing bottomed out at like a 54% chance, so maybe I'm being a little bit overly cynical that this doesn't have to happen, because they had it a coin flip just a couple days ago.
Yeah. And I think the stakes, the Democrats are really trying to scratch out something here, but there really isn't a lot. I don't know that there's a lot of support for spending billions more on healthcare for folks who have either overstayed their welcome or were never welcome in the first place because they didn't properly come across the border. So I think that we're going to see a fight. And in all likelihood, though, I would bet you, Oliver, that if we indeed do have a shutdown, which seems likely, that it'll be relatively short because the midterms are not far off and the Democrats don't want to be tarred with that brush.
Yeah, that's well said there. Nice wordsmithing there, Dr. J. Hey, I'm looking at to that last point you just made about how many days. Right now, for more than 5 days, it's trading at 65%. For more than 10 days, 44%. Also up and to the right, this chart over the past week. So, I mean, it's getting kind of messy.
Yeah, and it probably should be sort of messy. So, in other words, if you read into that, those prediction exchanges where you've got people putting real money on the line, not just their opinion, I'd say it sounds like it's between 5 and 10 days. Like you said, 65% to 44%. So the fact that it trails off after 5 means we're probably looking, at least in people's minds that are betting, that we'll probably see 5 to 7 days, so as much as a week. But that could be a really painful week because we both know there's a lot of vulnerable folks that really do need to get that check. And I think depending who they blame for the shutdown coming, that is not going to bode well for them in the midterms.
Yeah, fair. I feel like I would fade the more than 35 days. I think that would be pretty extreme, but I mean, it's only at 15%, but still, hey, that's not a bad trade for, I guess you'd have to wait 35 days, but probably not. Well, probably you're only going to have to wait a couple, I think.
And like you're saying, Andrew, I'm sorry, Oliver, the thing here is that if it's a 15% chance, that means you've got 85% on the side that if you win, you're winning an awful lot, for a very small bet.
Exactly. Your odds are good.
Looking for those kinds of odds. I know you do when you go to the table.
Exactly.
Yep.
Collecting premium, baby, raising in position and taking down blinds. That's the 85% trade. Okay. So let's bring it back to markets then, John. Let's talk the implications. I think part of that, though, is kind of feeding into the gold run, which has just been unstoppable.
Yeah, truly unstoppable. Silver, pretty much the same way. Silver stalled out a little bit more, but gold, I'm looking here again, the 25th, it was $344. That's the GLD, $344 a share. It jumps up. Just yesterday, it was $352, and it just keeps going higher. And these are big bets. We're looking at 53,000 contracts yesterday were placed at the November 360 strike. The day before it was October 350 strike, and that was also 53,000. So these certainly seem like big trades when you've got 5.3 million shares equivalent of an option trading. That's a big bet that we're going to see, obviously higher prices. They've been right so far, and I wouldn't fade them at this point.
You said the 360 strike, so they're a little out of the money by like $5, but man, this thing has moved again. A chart. Every time I look at it, it's just incredible.
Yeah, it is. It's incredible, and it's a run like you haven't seen since since John Paulson made that great call on gold a couple decades ago now. But obviously, he's down here with me now in Puerto Rico.
Right? Yeah,
I
exactly.
should wander over to his house and ask him what he thinks today.
Yeah. You also got Mr. Schiff down there too. Everybody getting their 51% in together.
Two gold bugs right there, and I think
gold
both
living in harmony with crypto nights, right? Because you got all the crypto people down there too.
There's a lot of crypto guys, but they're not as happy as the gold guys because a combination of people that don't have hardware wallets, software wallets, confidence in digital assets. They want hard assets like gold. That'll change as we go forward with these DATS, DATS, digital asset treasuries. But right now, I think a lot of the money that would otherwise be looking for either puts or some sort of protection is buying gold.
I like that too. I think that is also basically a solution because you're a lot of times wasting money on the puts. That's kind of what we're talking about here all the time. So gold presents itself as another a solution, an alternative, basically, because it seems to go up when markets go up. It seems to go up when markets go sideways, and sometimes it goes, steady or up if markets go down. And that's the key distinction still in my mind from crypto and BTC, because even this year too, even though the timing was different, Bitcoin still did drop 30% from the high. Let's not forget. So, John, great stuff on the government shutdown impact, the Kalshi trades. Appreciate it, Dr. J. Enjoy PR. We'll catch you or your brother tomorrow. Thanks, man.
Thank you.
All right.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
Welcome back to Chicago Future of Finance. We're live here on the floor with Tim Urbanowitz, joining us, the Chief Investment Strategist at Innovator ETFs, where viewers will notice in the background, I don't know if they can see, you guys have got a couple of new funds coming out tomorrow, but this is the monthly update to your series of buffer funds. It's great to see you, Tim.
Great to see you too, Oliver.
Congrats on the launch here tomorrow. I was kind of joking with you. Part of the reason I'm doing these funds is almost like you get to do a marketing campaign every month.
We do. I mean, that's the beauty of it. You know, we get fresh starting parameters for investors every month, and we're really excited about these. This is the first ever suite of dual direction ETFs, which give advisors and their clients the ability to make money not only if the market goes up, but also when it goes down. So things that have been available for a while in the structured note world, we're bringing
super
them
popular
into the ETF
now.
world. Yeah, exactly.
Like everything, it seems, has this angle to it, which is about protecting downside. We started the show talking from the option side about the JP Morgan Hedged Equity Fund, which is, again, another thing that's kind of designed to limit downside. You got all the buffer funds that have become very popular, designed to limit downside. Why do you think that is?
Well, I think, at any point in time, we're working with advisors who tend to work with wealthy individuals. And what you see is that those wealthy individuals, they've already made their money. They don't want to get rich twice. They want to protect that capital.
Yeah.
And what's a little different about these dual direction strategies, you've had the buffers out there for a while, which really focus on downside protection and upside participation. The dual direction, they're going to give you the upside participation, but you also have the ability when the market goes down, you're making money when the market goes down. So just as an example, you look at DDFO as an example.
That's the one coming out for October.
That's the one coming out October. That's the 15% dual direction strategy.
So that would be for this past month, DDFS.
Correct.
I'm actually, if we can take my screen here, I'm actually going to pull up your guys' thing here because why not? It makes it easy to follow along. The diagram is basically showing you that in the number of different market outcomes, you're trying to make money in 95% of them, which is important because this line goes up on as we go down into the negatives. That's your point.
That's exactly it. So, just like a normal buffered ETF, the DDFO has an upside cap. So right now you're looking at about 8% on the upside. So market goes up 0 to 8, you're going to be up 8%, right? Anything beyond that 8%, that's what you're giving up. But the difference here is you have an inverse cap on the downside, meaning that if the S&P 500 ETF goes down 0 to minus 15, you're going to be up.
How do you pull that off?
So we use options-based strategies. Hence why we're here at the
so
CBOE.
you selling spreads in both directions or what?
Yeah, so it's just various different option strategies that we piece together, and we put them together in a manner where we know the exact payoff that you're going to get. We've been doing this, in the buffered space for since 2018. We have over 450 different outcome periods that have
You guys are very early in this. We were just talking. You came on my old show way back in the day. We were early on with this.
We were the first ones to do it. We continue to be the market leaders here. First, dual direction strategies. So it's very different. And we're really excited about this because not only is it protection, but also, S&P 500 sells off 15% over the next 12 months. You're going to be up 15% with that strategy. Sells off 5, you're going to be up 5.
Okay, so take me through some of the details again then, because obviously this diagram is not symmetrical, because when you go up, you'd start to get capped. But it's almost like, are we rooting then for the market to go down if I own this thing?
Yeah, you're
because it looks like my max payoff is down 15%.
You're really rooting for the market to do anything, right? And obviously the trade-off here is if the market goes up 20% over the next year, you're going to be capped out at that level.
Right. So it seems like my ideal outcome is market drops 15% for the bang for my buck.
That would be the best case scenario for that strategy.
Okay. So it's almost like this is all an alternative too. So let's say if you wanted to short the market basically, and maybe you don't have the tools to do that, but you've got a decent amount of capital, this kind of does that for you in a way. So that's where give me the juice. What strategy kicks in there?
It does it for you in a sense that if the market goes down, you're going to make money.
Yeah.
But you're not betting against. So in the sense that you're not going to lose if the market goes up. You're not going to participate fully. Again, if we're up 15, 20%, that's where the trade-off comes in. So this is not something you're going to go out and necessarily, unless you have a view on the market, not something you're going to go out and replace your core equity with. We have a lot of advisors.
Very much so.
They're looking at this as a cheaper alternative to their hedge fund allocation, a lot as a way to replace some of their bond allocation because you are getting that inverse correlation when the market goes down. And then there's other advisors that they have retirees, pre-retirees. They don't need to hit 15% market return.
Yeah.
They're going to be okay with that 8 to 10% on the upside. And then, when the market goes down, either the protection or the inverse cap.
I totally get the differing logics of why people want buffered funds for sure. But what's so interesting about yours is that kicker to the downside, because in the other ones, it's much more about preserving capital, where this is, I see almost like you are taking sort of an active position in a way, which brings me back to how the sauce is, cooked into the pot here. Is there that much premium in that you can harvest? Are there that many people, is it that empty down there at down 15% or what?
Well, we're making it a zero cost option strategy. So really the kicker here comes into where we're able to set the cap. We're always going to have the inverse cap and the buffer on the downside. Okay, we're going to set those option positions where we need to. But on the upside, what we're going to do is we're going to sell a call at the exact level necessary to offset the cost of what we just put together on the downside. So that's going to be the variable. So when this strategy resets a year from now, what you're going to do, you're still going to have that 15% inverse cap. And then on the upside, the variable is going to be where can we sell that call to offset the cost of the other option strategies that we've purchased there.
Now, is this a volatility structure that has become kind of the standard in this sort of post-COVID grind up? Because there's an irony here, which is that these strategies that are kind of portrayed as protecting against the downside are becoming very popular as the market just keeps going up. But again, I think there's a very specific thing that you can express here that has a great deal of unique value.
It is. And, downside protection, again, is important no matter where we're at. Right now we have a lot of advisors that are allocating to these strategies or to just our traditional buffer lineup as just a way to hedge against, what might come. You have the market trading at all-time highs. You have valuations that are up. Things need to go right to make sure this market keeps going up. So this is a way to put some protection in when, you might not feel like you need it right now.
When I'm thinking from the retail trader perspective, like some of the people who are, very sophisticated, they have strong views on markets, like we talked to Hood some and other places, is it's hard to short things basically, and it's expensive to do so, and it requires a lot of work and attention to the market as well. I kind of like this as almost a surrogate kind of short expression, basically. I don't want to keep pushing that because I know everybody has different uses. But back to volatility, is this a structure that's going to hold long enough for this to work ad infinitum, or is this the result of like a compressed vol kind of environment?
No, I mean, to be honest with you, the higher we see volatility, the upside caps on this strategy, on our buffer strategies, they're positively correlated with volatility. Meaning that the higher volatility you have, the higher that upside cap is going to go. The lower volatility is, like we see now, that lower that upside cap is going to be. So that's going to be the variable. Interest rates are a factor as well, but higher volatility is very much welcome in these types of option strategies.
Okay, nice. It's very interesting. I like it because I kind of, we hear so much about the buffer stuff. It's become so popular. This is a unique twist.
This is the next iteration.
It definitely has a unique twist on it for sure. Good stuff, Tim. Thanks.
Great to see you, Oliver.
Yeah, welcome to Chicago. Good to see you again. Good to dive into it with the fun.
Absolutely.
Very interesting tickers behind us. DDFO, DDTO coming out for 10%, right, is the DDTO, 15% DDFO. Tim Urbanowitz. We're going to talk more ETFs. Cynthia Murphy standing by. We'll be right back.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
Welcome back to Chicago Future of Finance. Let's keep talking some ETFs. So joining me, Cynthia Murphy is investment strategist. And you've been on my beat for ETFs for a while. At TMX Verified, by the way. We've been talking about finance, ETFs. You've got a journalist background, which is why I think we've always kind of clicked on the subject matter. What's interesting to you? Because it feels like every time I do something for ETFs, it like blows up.
Yeah, it's been, I've been in ETFs since 2009. I was just thinking about that. It feels like forever. And what's amazing about this space is, as you know, it's been not only disrupting other investment vehicles, primarily mutual funds, but also with all the options-based growth, the derivatives use annuities and structured products. All of these types of products are kind of finding their path into the ETF wrapper, which has been fascinating. So the product innovation is constant. The amount of asset managers stepping in is growing constantly. So, the puck is always moving, and so it keeps us busy for sure.
There is an interesting filing actually today about Dimensional and the class share kind of market structure shift, which is I don't really understand this, to be honest. Like, I didn't even really get this until somebody called me today and said, "Hey, are you watching this?" And I'm like, "What should I know about this?" Because it seems like I already kind of had this framework where mutual funds were just all kind of dying out, But I guess there is kind of still a need to have some kind of, hybrid vehicle or something.
Yeah, it's really not hybrid. I think a way to think of it is one strategy in 2 different wrappers. So it's a way for, I think, a lot of mutual funds, as you've been watching, a lot of outflows, persistent outflows over the years. And so a lot of these managers are trying to figure out, how do I get into the ETF space? Obviously, I need to be in the ETF space. That's where all the growth is. So things like 351 exchanges, mutual fund conversions to ETFs, all of these have been in the process. And
it
now
doesn't matter for the end user, right?
Well, it's a choice. It's a product choice. So it really is more now. You can open the floodgates to a lot of mutual funds out there can just implement an ETF share class of that existing strategy. So the good thing for the ETF space is that this would be a brand new ETF that comes with a long track record of the existing mutual fund, because they carry that track record. But they get to be implemented typically at a lower fee. They get to be intraday traded. They get to be transparent. So it's kind of like a path, I think, for the asset managers to expand their offering and reach this audience that can't get enough ETFs.
Beautiful. That's why I love it. That's the journalist-specific take that I needed. So especially when I think about from the customer side, because I was thinking, all right, a fund shows up, available to buy. Who cares what the process it went through? But to your point, because it'll have the back data from the existing mutual fund, that actually is a nice kind of little bonus there where it's not starting from scratch.
Yeah, absolutely. Because we know if you look at the advisory channel, a lot of them still use that 3-year life track record as a metric before they consider entering in a strategy. All these mutual fund legacy metrics to adoption, they still hold water in the ETF world. So now you have a brand new ETF that already has this long track record.
Yeah.
So the good news is there'll be way more product choice. The bad news is there will be way more product choice.
Exactly. Because there's already more ETFs than stocks.
So, I love to quote this number. Dave Abner from Northern Trust back earlier this year, estimated that we'll go from 4,000 ETFs to 7,000 ETFs like that once the share class approval comes. So if you're an advisor then you got to do this due diligence. I mean, your job just got much harder.
Wow.
So
Sounds
we're
like the
all
job for
curious.
AI.
We're all curious to see how the adoption actually happens. And just because a mutual fund exists becomes an ETF doesn't mean it's a good product. There's a lot of bad mutual funds out there that just having an ETF share class doesn't mean that strategy is viable.
And that's where too,
So
I would
there'll be a
say
lot
that
of
like,
noise.
yeah, there's definitely gonna be a lot of managers who now say, hey, we're an ETF, but
Yeah.
like, okay, do you cost the cost of a standard ETF, or are you still carrying a mutual fund cost?
Yeah, exactly.
You
So
know?
and from what we understand, from when we talk to the asset managers out there, comes the approval, great, let's go, great. The industry is not ready for it. So, there's a lot of conversation about the actual operational plumbing to make this happen is nowhere in place.
Okay.
So I don't think it's going to be an overnight thing where the funds just multiply. I think now that with the approval, these firms are going to start figuring out how to actually make that happen, how the custody looks like, how the trading looks like, because these mutual fund shops don't have all the infrastructure to manage daily trading of an ETF. So all of that's still going to happen. So it's going to be a slow.
It's a great point. They're coming. It may not be overnight, but that number is going to get big.
Yep.
Their number's already big. Do you see it as kind of a fun novelty that there's more ETFs than stocks now? Or is that just kind of like, hey, business as usual, this is the investment world, like we're going to make products,
Yeah, I think it's a testament to the viability of the structure. It has yet to be disrupted with something better. It has broadened access. I'm always impressed that there's still first of a kind products. There's still innovation. But I know versus the number of stocks, I think we like milestones. So it's just more of a conversation point than meaningful statistic.
There were more mutual funds than
Yeah.
stocks. Okay, so let's talk about some of the shorter term stuff as we come up on the last quarter of the year here. Because there's so much money in ETFs, what are we watching in terms of rollover, turnover, rebalancings, or just where the flows are going, basically?
So today is the last day of the third quarter. So unfortunately, we don't have the final quarter numbers, but I was pulling up data this morning. And what we can tell from the third quarter is ETF demand has actually picked up pace in third quarter versus previous quarter. So almost $400 billion in assets just this quarter, which is massive. Year to date, we're already over 900 billion. So we're probably going to cross last year's record. So the story is great year for ETFs, lots of assets going to ETFs. They continue to be the vehicle people are using to navigate uncertainty and all of that, that we know.
What's the hot kind of theme? Is it still very tech oriented? Are the flows following the price, which has generally been led by that group?
So I think there's a few broader trends that I've been watching over here that have been very persistent. So one is, surprisingly, appetite for your low-cost beta.
Okay.
So a fund like Vanguard's VOO, S&P 500 fund, super cheap, like tons of assets, another $83 billion.
Well, it
crazy,
keeps working.
crazy.
Keeps going up.
But also in that category, like SPLG, which is the Spider low-cost S&P 500 ETF, 3 basis points for that portfolio. That is like top 5 asset gatherer this year. It's been consistent.
Quick way to get to the top is to be the cheapest.
Exactly, but it's not it's not the trading vehicle favor. It's not SPY. It's not some of these popular trading options. Same thing with QQQM versus QQQ. QQQ not as strong in asset gathering. QQQM, which is the cheaper QQQ, tons of assets. So I think it's been really interesting to see like the appetite for your low cost beta building block, whether that's advisor, whether that's
Building
retail,
block, that's a good term,
just going there. It's
step
been
one.
really interesting to see that demand, and that has been persistent. Every quarter continues. Another big theme this year has been the year of the diversification. So if you look at if you take equity and fixed income out and you put everything else in kind of the other bucket, alts,
Gold,
commodities, crypto, all of that.
What about the hedged equity stuff?
Yeah.
Alternatives, right? Options based in that category?
All of that has taken over 10% of all asset flows this year. But if you look at their asset footprint, it's about 3.5%.
Are buffers in that category?
Buffers are in the active. So you take that out.
Okay.
So alternatives is a big broad category, have taken in 3 times their asset footprint this year. It's been a big year for the diversification.
Okay.
Gold looms large there, precious metals, crypto, huge, as you know. Lots of managed futures ETFs taking in assets. So it's been a big year for that appetite for diversification, and that has also been persistent and continuing this year.
SPY is going to get a little bit more love here, or your low cost too. They're screaming because the market's ripping. Okay, so it's interesting that you mentioned the buffers in the active category, because that was the first buffer I've kind of thought about as being active, the one we just talked about with innovator ETFs, because they've got that asymmetry where you actually get your biggest outcome if the market goes down.
Well, the trick of the active category today is that is now what we think of traditional active, that stock picking, discretionary, unconstrained strategy. Really is a lot of it is like it has an options overlay. It falls into that active category. So active is taking over almost 40% of flows this year, huge category. And derivative income, biggest asset gatherer as a category,
Bingo.
and defined outcome.
Chicago.
Going, yes.
Okay, so tell me that again. I love when my priors get validated. Is there any better feeling? Okay, so options driven income is the fastest in what category?
Active. Within active, this
Bingo.
year is taking about 15% of all flows. It's gone into
Wow.
active, going derivative income. So it's picked up more assets than the ultra short bond category, large cap blend category.
50% of all flows in the active
15,
category
yeah, yes.
is options income.
It's
Okay.
been options income. So it's been a huge
Yeah.
appetite. And then defined outcome category also growing dramatically. So again,
Right,
it
which is
speaks
the
to
buffers.
that diversification, that protection. A lot of how do you minimize downside losses has been a big thing this year.
Yeah.
So
Dude, by the way, do you find
outcome-
that ironic as I do? The market keeps going up, and like some of the most popular things are about hedging downside. Like the irony here.
It's ironic, but it's also reassuring. Like
Sure, yeah.
we're not just going crazy and just buying
True.
the leaders, because
People
we
buying
learned,
the building blocks.
and earlier this year we learned the leaders turn laggards quickly, like the Mag 7, and then okay, they turned it around, but you can be on the wrong side of that trade very quickly. So I'm loving the discipline of
Yeah.
worrying about downside losses. So
All right, fair enough.
I think
yeah.
it speaks to the health of the investor mindset today.
The F1 drivers in Germany, traders, those guys had differing thoughts. They were all about hitting the gas, then hitting the brake, but that's kind of their style. So great stuff, Cynthia. Great
Yeah.
perspective as always. Appreciate it.
It's great to see you.
Thanks for bringing us the latest ETF news as well. Great stuff there, helping us figure out the difference as mutual funds convert into ETFs. Scott Bauer's with us. Yeah, let's talk about the market. It got pretty noisy over here a minute ago, Scott, because market just ramped up pretty nicely. S&P futures 67.42 right now.
What a rip higher. I was just talking to some people about that. I mean, 20 minutes ago we were, just hovering flatline, maybe a little positive, and boy, there seems to be a lot of optimism going into what could be the 11th hour tonight with a potential shutdown.
Yeah, we were talking about that Kalshi at 86% for that.
Yeah.
Generally, I feel like it doesn't matter because we do it so much, but maybe the best thing that can happen is the government just takes a break and let markets do the work. The S&Ps don't care about this.
No, they don't. And it's real interesting because if you look at the last 6 times that the shutdown has been 5 days or longer, 4 of those 6 during that shutdown period, the market's been higher. The 2 that weren't, they were marginally lower. So the market doesn't really look at this as something that is detrimental to the rally that's going on. Now, if this thing does happen and it extends weeks, maybe a month, now you're talking that you could see some real impact into some of the economic numbers in the data. That's where the risk to the market comes in. But boy, the freight train has left the station.
Yeah. The odds of the government shutdown extending more than 10 days is at 38% right now on Kalshi, moved up a cent. So that number, I mean, yeah, it's a pretty real number. It's not to be ignored.
No, it is a real number. And so, it's real hard to balance history where we kind of been there, done that, and it's like the little boy that cried wolf kind of scenario where, all right, they're going to figure this out by midnight tonight, versus this is a little bit different of a political climate that we're in right now than, when we've been going through this in the past. So I personally think that we will shut down. It'll probably get resolved, at least in my opinion, by Friday. So we get those jobs numbers, which I think are going to be pretty poor. And then we go from there. And then all of a sudden, we turn the page, and now we're going to be talking about the Fed again, what they're going to do at the meeting later in October, and earnings season, which really begins next week.
I think the data for ISM services could be interesting later this week. Manufacturing expected to stay below 50. ISM's services expected to be above 50. I'm going to pull up my risk radar here for a second, Scott, to kind of give some context for the way I viewed it, which is green for stocks, the icon down there, bullish. I mean, yellow for basically everything macro, Scott. And that's kind of where I think the market wants it to be.
Well, we've got this good news, bad news scenario, right? Bad news is good news for the market. Good news, maybe not so much. Although I would say with the numbers we got last week with GDP, boy, that 3.8 number almost approaching 4, and then weekly jobless claims last week, which were much lower than expected, and the market shrugged it off. You know, those are two things there that really could have given us a shift to the Fed again, or to the curve for how many cuts we might get. And yet here we are.
Great point. Great point. Because I was looking to see if maybe the dollar would firm up. And it hasn't really. You know, it's held, but it hasn't broken out. So that tells me that, you know, it's still stable, and the market's telling us even if the data are strong, it's not going to change really the dovishness from the Fed.
Yeah, you know, it's so interesting to look at what has happened this year, Oliver, because the patterns, the historical patterns we've seen from January effect to, you know, what happened on Liberation Day, and then selling May and go away. And then August and September, supposedly, you know, the two worst months of the year, which historically they are. These trends have just not held. So we're coming into this period of time, the last quarter, there's a closing bell, at least not for behind you, but this last quarter of the year, which is supposed to be really the best quarter of the year, nothing would surprise me here. Now, I think it's really, really difficult for this freight train to stop right now. There is so much momentum to the upside. That being said, it could just take one more shoe drop. And I don't know what that shoe drop could be if it is not geopolitically involved. The market is kind of numb to the tariff. The market is numb to the tariff situation, numb to interest rates. So God forbid something happens, you know, geopolitically, that could be the one. Otherwise, as a trader, as much as people don't like this rally, as much as people don't like, you know, seeing the market seemingly at all-time highs every day, you can't fight the trend.
I mean, grind it away. All those money flows going into SPY, saying people are loving it. Cynthia talking about people buying the building blocks, you know. But then at the same time, they're also buying the hedge stuff to the downside, which is kind of ironic. So I get your point too, that, you know, there are doubters of it. But to your statement, Scott, it seems like unless you get something major, askew from the outside, then it's, you know, a freight train that's looking pretty solid. And basically betting against geopolitical risk is like the number one brick in the wall of worry that we climb. So
I mean, that, you know, that's the 9 out of 10 scenarios, right? You bet against it, nothing happens. And then finally, at some point it catches up. And we hope that's not the reason that, you know, there might be a market sell-off. But to me, I'm not sure that any of the economic data coming out really matters right now. It doesn't seem to matter.
I had a line drawn on the chart of bonds that was showing a lot of support, and it kicked in basically right where you'd expect it. So it's not like anyone's doubting, I think, the overall dovish message. Glad we got you, Scott Bauer, back on the show. Appreciate it. Thanks for the thought, man.
Great seeing you.
Yeah, have a good one. Scott Bauer, CEO, Prosper Trading Academy. That's the bell. We got people getting ready to ring to celebrate some funds. Thanks for tuning in to Chicago Future of Finance. I will see you tomorrow at the same time, 2 to 3 p.m. Central.